You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast.
Welcome back, everybody. Welcome back, Brandon. How are you doing this fine morning?
Yo, it is a fine morning, actually. Is it a fine morning in Melbourne? Because it is a very fine morning in Canberra. Yeah.
Honestly, this sounds really bad, but I haven't even looked outside yet, so I don't know.
You haven't surfaced from your dungeon.
No. One thing I was just thinking, I really need to start eating breakfast before we do these podcasts because I'm not a big breakfast person.
Really?
So usually I'll have a coffee as soon as I wake up. So if I wake up at 7, I'll have a coffee, but then I'll delay breakfast until maybe 10 or something like that. But then sometimes we take a little while to get going with the podcast.
It's true.
And then if we finish and then maybe we'll have a chat afterwards and we finish at 12
it's
and
lunchtime.
I am starving. I've been doing that for the last 4 weeks. I need to stop.
Did you eat this morning?
That. No, I didn't.
Oh no. That's all right. We're recording a little bit earlier than what we normally. We're sleepyheads on a Thursday morning, aren't we?
Yeah. Well, I mean, I was up, but I was just engrossed in some news that has sort of unfolded over this week that I was just sitting down watching a bunch of interviews and stuff on CNBC and reading articles, and I just totally blanked that I probably should eat something.
I get when I wake up, if I don't eat straight away, I start getting stomach cramps. I don't understand why. If maybe there's some dietitian or someone out there. Don't tell me I've got some sort of weird stomach cancer, please.
Jeez.
But yeah, when I wake up, if it's my body is just all right, go and eat breakfast, and then if I don't, it's go and eat breakfast.
Yeah.
And if I don't, it's you will eat breakfast.
No, I'm the complete opposite. If I eat something immediately after I wake up, I feel terrible. I just feel sick. I have to have a coffee. And that's it. That's all I can stomach for the first 2 hours of being awake.
Right. There you go. Oh, I'll tell you something cool that happened to me yesterday. Well, it didn't happen to me. I went along to this. Do you know yesterday they were celebrating the Australian Air Force 100-year anniversary?
No, I did not know that.
What they did is here in Canberra, around the Lake Burley Griffin, they did flyovers from 60 different aircraft.
Wow.
Which was so awesome. And these are military aircraft. Sorry, this is completely just random and off topic, but it's something really cool. So they had for an hour and a half, they just had flyovers from the top fighter jets and the really heavy lift aircraft. Man, it was so awesome. They were all flying really low and you can get a really good look at the aircraft. Man, that was so awesome. But holy smokes, fighter jets are so loud. I always forget how loud they are. They will make you deaf.
Yeah, I was gonna say I saw. I think he posted something on Instagram or something like that. And,
yeah, that's right.
Yeah, it looked interesting. So does everyone just was a lot of people just kind of down, just gathered and watching? Is there
they were just
designated area?
Yeah, they were just all around the lake, just people just sitting all around the lake, and then the aircraft did these flyovers in the lake. I really liked the heavy lifting aircraft. They are so big. It is insane how big those planes are. It looks like when they're going along, because they're flying really slowly so people can have a good look at them, it looks like that shouldn't be possible. Something that big made out of metal, how can it be traveling through the air so slowly? I feel like it should just be falling out of the sky.
It seems to break the laws of physics.
Oh yeah, I know. It just looks insane. But anyway, that was really fun. And I definitely encourage anyone, if you get an opportunity to go to an air show or an airfield and have a look at some cool planes doing flyovers, definitely do it. It was really cool. Anyway, sorry, that was a complete tangent. Not at all about the stock market.
That's all right, Brandon. We need tangents to get these podcasts going. We need something
that's true.
to get the conversation flowing. But we've got a lot to talk about today.
All right. Let's get stuck into it.
I don't know how we're going to fit all of this in, but yeah, we'll get straight into it. So today's episode is sponsored by Sharesight, and Sharesight is an application you can use to track the performance of your stock portfolio, and it will allow you to keep track of all of the different types of gains that you experience as an investor. So capital gains, dividends. If you have dividend reinvestment plans, then it will do all of those calculations for you. Currency gains, if you're buying shares internationally or you hold foreign currencies. And then the main reason why I've personally been using it over the past 3 or 4 years is when it comes to tax time. So Sharesight generates up to 10 different reports that can be used at tax time to work out things such as capital gains, dividend income, and more. And at the moment, you can try Sharesight for free. It's a free plan. So head over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. And if you use that link, you can also get 4 months free when you sign up to a yearly subscription. So go check it out and try a free plan for as long as you want. And if you want to upgrade, you can also use that link, and you'll be supporting this podcast. And a big shout out to everyone who has signed up to Sharesight over the past couple of years now. I guess we've had Sharesight as a sponsor or the past year or so.
It's a good point to bring up, actually. Yeah, we definitely do thank those that have, first of all, decided to sign up for Sharesight because it's a good platform, but decided to sign up with our link because we don't try and make money with this podcast. It's not what this podcast is about. This is just kind of about us getting together weekly and discussing what's been going on in the stock market, and hopefully you guys can get something out of that. We do have an editor that edits each podcast, and that's our main ongoing expense for the podcast. So if you have signed up to Sharesight using our referral code, you can know that that money goes directly not to making us filthy rich, but to actually supporting the podcast and getting it edited and out every week. So just thought I'd chuck that in. But anyway, what's going on with this? You found some crazy news story that I know nothing about. So tell me what's going on. This is a long one, but it sounds like you've been really digging in and doing some research on this.
Yeah, I don't know how you haven't seen this. This was
maybe I've just been living under a rock or something this week.
Too busy watching the planes go overhead to
probably.
No, but this is, I mean, it's kind of an obscure story in that it's very complicated. So it's not something that a lot of people will easily be able to like talk to other people about, I guess. So it hasn't kind of gone far and wide in that sense, but some of you may have seen in the news that there is an investment fund called, now I'm going to butcher this name, Archegos or something like that, that was forced to make a $20 billion margin call this week. And that obviously caused some significant pain for that business, but it also flowed into a number of businesses on the American markets, on the Chinese markets, and also some of the American banks that were involved in this whole kerfuffle. So I'm going to do my best to break down step by step kind of a timeline of everything that happened and explain the main instrument that was used that basically blew up this fund and destroyed it, and all the people that were involved. So sit back and relax.
So clearly so this fund is definitely Cactus now, is it?
Honestly, I don't know.
Not sure.
It's very uncertain what it's the dust is still kind of settling on everything. Okay. And there's not a lot of visibility, as I'll talk about, because the fund is not an investment fund that anyone can invest in. It's actually a family fund. So even though it had a lot of money in it, it's a family run fund. So we don't have a lot of clarity on what assets they have and what's left and anything like that. But
right.
Archegos Capital Management is basically a family-run fund, and it's owned by Bill Hwang. And he basically, the story of Bill Hwang was he started a hedge fund. So this was a fund that big investors could put their money into, or big wealthy people could put their money into. And he started a hedge fund called Tiger Asia Management in 2001. And that's really where this story starts. And at its peak, the fund managed $5 billion. So it was a significant fund, not something that was particularly small. And then the first sort of big event that happened for that fund and Bill was in 2008, there was a massive Volkswagen short squeeze. And this was a huge story. I think there's a Netflix documentary on this or something. And basically what happened was a lot of people were shorting Volkswagen, betting that it was going to go down and the stock was collapsing. And then out of the blue, Porsche bought Volkswagen and its price quadrupled in 2 days. So of course, if you you have a short position and the stock price goes up 4x in 2 days, a lot of people who were shorting that got absolutely destroyed.
Right.
And one of the funds that got destroyed in that was Tiger Asia Management, which is run by our main character for today's story. And then, of course, there was some aftermath from this. And in 2012, Bill Huang was found to be committing investor fraud, stock manipulation, and insider trading. So it wasn't just that he made a bad trade. He was doing a lot of illegal activity involved in that particular trade, but also in other aspects of the fund, which were kind of came to light after they lost a ton of money in that particular short squeeze.
Right. Okay.
Yeah. So he basically ended up getting an SEC fine of $44 million, and he closed the fund. So that's kind of the first chapter of this man's career was not too good, right?
Let me guess. He comes back.
He comes back, and he does better. He never breaks another law. He does. He only makes smart, safe, long-term investments. He actually just invests in the S&P 500, and then he makes people a lot of money. That's the end of the story.
I do not believe you. I do not believe you.
No, of course he didn't do that. Of course not. So
all right. So what happened?
Yeah, so he took a long time to come back. He closed the fund in 2012, and then in 2013 he opened a new fund. He waited a whole 12 months, probably less than 12 months. I don't know the specific dates, but he opened this time a family-run fund called Archegos Capital Management, which is the fund we're going to be talking about today. And a couple of things that are important is because it's a family-run fund, or it's a family fund, it's like a trust. Right. All the investors are connected to Huang in some way. So when you set up a trust, you have to detail who's involved and how they're connected to you. Right. And these family funds are good if you have a lot of family wealth, because you're not required to make a lot of the disclosures about trades and positions like you are if you run a hedge fund, right? If you have a big hedge fund, we know that in the United States, at least, you have to make a 13F filing, and you have to detail all of your portfolio, all of your long positions. That's not something you have to do. Now, I'm pretty sure this fund was in Hong Kong anyway, so they probably have different legislation, but in any case, that it was a family-run fund. So they were able to hide a lot of what they were doing over the past 8 years. And now we know that Huang's plan in this fund over the past 8 years was basically to grow the fund by using huge amounts of debt. So he would take on huge amounts of leverage, multiple times higher than the amount of money in the fund. So for example, if you imagine you had $100,000, you might be taking out $800,000 worth of debt on that and investing it in risky stocks. And that was his plan. And he was actually able to grow the fund massively over that time. And one of the key instruments that he used in doing this was something called a total return swap. So I'm going to do my best to explain this. And I know this is a really long story, but it is kind of interesting, and we may see a lot more from this in the future. So it's kind of valuable to, I think, understand everything that's involved here. But a total return swap is, of course, a derivative. It's a contract that big investors use. And basically how it works is it allows a fund, so a fund like this individual, to benefit from a stock increasing without having to buy or own the stock and assuming its risk. And how that works is a bank buys the stock on behalf of the fund. So essentially a bank is lending money to Huang, but instead of just giving him the money and he buys the stock, the bank just buys the stock and holds it. Okay. And as a result, the bank holds the stock and therefore assumes the risk of it declining. So of course, if that stock collapses, the bank's holding it, right? The bank's holding the bag. So they're the one that's in trouble. And how this swap basically works is there's a return that kind of goes in two directions. First of all, the fund, Huang's fund, pays a fixed rate to the bank, which is basically like an interest payment, right? We're investing this money on your behalf, so you have to pay us for basically interest on that. And then in reverse, Huang receives a percentage based on how much the stock goes up. So that's why it's called a total return swap. Basically, the return that the stock generates is what is paid out to the investor in this case.
Right.
So I got a little quick example between Brandon and myself, just to maybe cement this a little bit. So
a real life example.
This actually happened last week.
Did.
Yeah. So
wait, am I the one holding the bag?
No, I'm the one holding the bag. You're just the dodgy person using these dodgy instruments. So neither of us are really in the clear here.
Okay.
But let's say that I'm a bank and Brandon is Huang in this case. He's the person who has an investment fund and wants to create a total return swap. So in that case, let's say that the bank, I buy a stock on behalf of Brandon for $100. That's your stock, but I'm purchasing it and I'm holding it. So I assume the risk of that stock. And in exchange for taking on that risk, Brandon has to pay me $1 every month. So Brandon's paying me $1 every month. And in return, I'm paying out Brandon the return that the stock generates. So if the stock goes up to, say, $105 next month, I will pay Brandon $5. He'll give me my $1 in interest, and Brandon has made $4 without assuming any risk of the stock collapsing.
Yeah, that makes sense.
So assuming that the stock had collapsed, Brandon would be out $1 and I would be out 100. So the bank gets screwed if the asset basically fails.
I see.
And Huang had these deals with a lot of investment banks. And a lot of people are wondering how on earth all of these banks fell asleep and accidentally let this guy be a client of all of these major banks after his track record. But we had Credit Suisse, Morgan Stanley, Goldman Sachs, and a bunch of other banks as well that made these TSRs with him, TRSs with him. And we don't know exactly how much debt yet. As I said, the dust is kind of still settling, but it's estimated to be about $50 billion of exposure on a $5 billion portfolio. So 5 to 10 times their funds, which is just ridiculous, right?
Holy smokes.
Especially when you get to that scale, right? Like it's one thing for someone with $1,000 to take on $10,000 in debt. Obviously that's insane, but it's another thing when you have a $5 billion fund. Yeah. Taking on
super scaled.
Yeah. It's pretty crazy. And the other crazy thing was all of this money was concentrated in just a handful of stocks. So it wasn't widely diversified. It wasn't protected in any way. It was really in 5 stocks. It was in Viacom, CBS, Discovery, Baidu, GSX, and Tencent. So a couple of American media companies and a few Chinese companies. And the first hint that something was maybe going wrong here was investment bank holdings in those companies started to explode. So in each quarter, they have to detail who owns the most stock. And these investment banks were massively increasing their ownership in these companies. And because it's very unlikely that the investment bank on their own accord would put a massive position in these companies, we kind of could see that, or well, in hindsight, we can see now that they were buying this on behalf of the client. But we still didn't know who it was. Yeah. And then there was the fallout. Then it all started to go wrong. Then it all started to go wrong because, of course, these swaps mean you can amplify your returns if they go up, meaning he has $50 billion of stock. If the stock goes up, he makes a ton of money, but that's not what happened. The stocks began to fall. Believe it or not, stocks can go down. No,
they can't. Don't listen to Hamish. He's playing silly buggers. Stocks can't go down. What are you talking about?
I just like to imagine this guy had a meeting like the day after, talking to the other managers or something, or the family members talking about the investment being like, and stocks don't go down. So this investment is flawless. I've never made a mistake.
So we're going to make a ton of money.
Yay!
All right. So what happens next? You've set this up, and I can just see this thing's gonna fall out of the sky right now.
So the banks are arguing, first of all, that they didn't know that he had these deals with all of the other banks. Which, look, okay, well, all right, but
whatever.
Basically, the stock started to fall, and the banks looked and saw, okay, wow, we have massive exposure to these stocks. We need to get get this off our books. So they basically asked Huang's fund to make a margin call. And the margin call was massive. It was $20 billion, which I'm sure is probably one of the biggest margin calls a fund has ever made in history.
So is this like a collective margin call from all of the banks together?
Correct. Yes.
Yeah, okay.
So he had similar deals with maybe 4 or 5 different investment banks, and collectively he was required to put up $20 billion. And of course, as I mentioned before, the fund had like $5 billion. So they didn't have the money. And as soon as he refused to make that call, the bank started to declare that Huang was in default, basically saying he doesn't have the capital to fund his debts. And then all of a sudden I think it was a couple of days ago now, but it was basically all in one trading session. Stocks just started to sell off massively because the banks were
Holy
like,
smokes.
okay, we're not actually getting our money from this individual. So we have to get these stocks off the books. We have to sell them now. And it's kind of a game theory outcome whereby, first of all of the banks spoke to each other, and they basically said, wow, okay, we have all of these exposed positions. Let's do this quietly and together as a team so that we don't collapse the stock. And that's what happened initially. But then one of the banks declared that he was in default, and all of the banks just panicked. So they of course go, okay, we've got to sell our position before the other banks sell theirs, because we don't want to be the last one, right? You don't want to be the last bank still holding the stock after it's down 50, 60%.
So they were together saying, let's do it quietly, and then one of them triggered the backstabbing, essentially.
Yes,
and then they're just all like freaking out, which causes a massive just shitstorm.
Yes, and we don't really know who went first or anything like that, but I was watching an interview before, and apparently Goldman Sachs is claiming that they made a profit on this trade. So Goldman Sachs looks like they were the smart one and they went first. Or smart or dumb, depends how you look at it. But it looks like they moved first and they saved themselves. And it looks like Credit Suisse is on the back end of this and is going to take a lot of losses. But in terms of the stocks, of course, the stocks got crushed because these banks were selling billions of dollars worth of stocks in these tiny companies. One of them wasn't tiny, or a couple of them weren't tiny, but Viacom went down 51%, Discovery was down 41%, Tencent, which is almost $1 trillion company, went down 34% in a session.
Holy shit.
Which is a really scary one. I'll talk about that in a second. Baidu was down 20%, and GSX, another Chinese company, was down 61%. That was the smallest. So these companies got crushed by this. And the big concern that a lot of people are talking about right now is some people are arguing, okay, this might be an isolated incident. This might be one idiot who's using a huge amount of these total return swaps and has just bungled it. But what is far more likely is because these kinds of funds are extremely popular, and the SEC reporting rules have been around for a very long time. So it's natural for rich people to want to find ways to not report. It's very likely that there are far more funds that have these swaps active at the moment.
Yeah, that is true. It's if there's going to be one, there's going to be a lot of them. Holy smokes, dude.
Yeah.
This story is insane. I was just browsing the actual stock charts of these these 5 different companies. That is insane.
Yeah.
Like, these are massive companies, and this event has triggered like 20, 30, 40, 50% declines. I looked at the CBS stock chart and that it's just a cliff. And this is just one dude with one flippin' family fund that's just essentially just, done something completely stupid. But yeah, you're right. Like, how many more of these ticking time bombs are out there?
Yeah,
that's crazy.
It's kind of scary because there's a couple of ways to look at this. One is, of course, a $20 billion margin call is huge. That seems excessive. It's not something we see very often. But the scary part is it's done on a fund with $5 billion. And there are a lot of $5 billion funds, or smaller or a little bit bigger. So is scary because particularly if you look at something like Tencent, which, as I said, I think now after the decline, it's about a $700 or $800 billion company or something like that. Imagine if that happens, and if there's another fund that has that amount of stock in something like Tesla or Amazon or Facebook. These businesses are all around the same size as Tencent. It could very well happen to some of those big companies.
Absolutely.
And it also could be the case that the run up of a lot of those tech businesses could be driven by a lot of this leverage in the market, a lot of these derivatives that allow you to extend yourself far beyond
what should be,
what it should be. It's
holy smokes.
It's quite scary to hear the word swaps again, because the last time, if you're thinking, where have I heard total return swaps before? Well, there was the credit default swaps that were used in the global financial crisis, that were used by I think they were used by Michael Burry to bet against the market, basically.
Exactly.
And that was the last time there was a significant amount of derivative contracts that no one really noticed were building up until they looked. There was all these CDOs and synthetic CDOs and all of these different things. If you've seen The Big Short, how they show that guy playing blackjack, I think, and then there's people betting on the person betting on the person betting, and it goes back a long way. Right now, we don't know if that's the case with these total return swaps. We've just seen one,
derivatives
we will
scary.
see. Yeah, it's very scary.
It's like they, in principle, they make complete and total sense, but in reality, they just get abused. They get, and that's exactly like that. That's exactly what happened in the GFC. I mean, derivatives got abused. And it never ends well, because these things, and there are some derivatives and financial instruments where it's like, they're like geared up to, so if something moves by 1, the derivative moves by like 3. So it can just, it just causes a flippin' mess. Yeah. To be honest, I'm not a huge fan of derivatives. And I just don't think you need them. It's oftentimes just quite risky, but anyway. What an insane story, dude. What an insane story.
It is crazy. It's also not surprising. Because
of course it's not surprising.
Debt is so cheap at the moment. And because stocks have gone up so much, the long-term return on stocks right now, at least argued by a lot of people who are into value investing, big successful value investors, they will argue that the long-term return from this point, when valuations are already so high, when stocks have already gone up so much, is going to be low. So you have these investment funds that have these terrific records. They don't want to let their record drop, because they'll lose clients. So they look for ways to amplify their returns, and they use debt and derivatives to do it. And it's incredibly risky. If some of these instruments are incredibly sensitive, the stocks that caused that margin call did not move down that much before the margin call was made. 10, 20% in some cases, in some cases less than that. So it really raises the question: are there other stocks that are this sensitive to these kinds of moves?
Yeah, that remains to be seen. But that story is actually quite important, because it opens everybody's eyes to something that could be happening at a much larger scale.
Yeah, I think...
Which I hope is not, but I have a sneaking suspicion is.
Yeah, I think there'll either be one of two things that comes from this. One is this is a one-off story and we never hear about this again. Or this is kind of the first one to fall in a similar way that you had banks like Lehman Brothers or Bear Stearns that collapsed first in the financial crisis, and people were wondering, well, is this just a one-off? Do the other banks have exposure? So,
but you see, the problem is that there's no way out. If this is a widespread situation already, there's no way out of it, because even if there's like laws that are brought in, or if, banks get together and look into this and say, okay, how are we going to protect ourselves here? We better start, margin calling some people We better start margin calling people that are in similar situations, or, we better, new rules come in and family funds or trusts or whatever are not allowed to hold, and not allowed to do this. So all of these trusts need to be unwound or something like that. There's no way out of it, because the way out is that it will still cause selling.
Yeah.
And that is exactly what causes these massive price movements in this case. So
yeah,
that's the thing. It would have to, if they were going to explore this and unwind it all, then they would have to do it so slowly so that the prices of these stocks didn't get screwed. It just wouldn't be possible.
And that's not going to happen, because people are not rational. Like, the rational way out of being in too much debt in the stock market is to unwind it slowly. But the irrational emotional side of you will go, I need to get out before everyone else gets out. Yeah. And that means you sell quickly. And if everyone thinks the same way, that's if no one's aware of game theory, look up game theory. That's very fundamental economic theory. Everyone just plays for themselves. Yeah. When they're uncertain of the outcome, they play for themselves, and the result of everyone playing for themselves in something like this is everyone loses.
It turns into, well, everyone's in the same situation and everyone needs to get out. But if you're the first to get out, then the consequence will be less severe.
Correct.
Naturally, it's like, oh, can we work together and unwind? No, I have to be the first one out. Yeah. Anyway, we've been talking about this for a long time, that is a crazy, crazy example. And it's something that, maybe if you kind of lost it along the way, go back and listen over it, because it's really quite interesting, and it makes you really think how many similar situations are out there. All right, shall we move on?
Yes, yeah. Everyone can wake back up now. We'll get back into some fun news that Brandon's put together here.
Oh no, that was a very interesting story. But you're right, it's just technical.
Yeah, it is.
It's just some, when it comes to derivatives and whatnot, sometimes it just gets a little bit hard to follow along. But no, you explained it well.
Oh, thank you.
All right. Next news story is a little bit simpler to understand. Robinhood gets rid of the confetti animation feature amid scrutiny over gamification of investing. This is something that's been increasingly talked about with Robinhood, is that Robinhood, it's fantastic. It democratizes, investing. It allows anyone into the market. But a lot of people have criticized Robinhood that they are making it seem too easy. And that, they're making what should be, serious financial decisions. They're making it seem like, a walk in the park. Like, oh yeah, you bought, congratulations, you bought $10,000 of a stock, confetti, well done, achievement unlocked, you're great.
Achievement unlocked.
Yeah, but actually, that's the whole idea. They are gamifying. And gamification is a very powerful concept, and a lot of companies use it, and it is effective because it keeps people interested. But there's like some things where you're like, okay, you probably don't want to over gamify this. So anyway, I'll actually read you what the article says. Robinhood is redesigning some of its app features, most notably ditching its confetti animation amid scrutiny over the popular stock trading company's so-called gamification of investing. The free stock trading pioneer, which is gearing up for its public debut, told CNBC, the move is an effort to remove the distraction from its overall mission to democratize investing. That's BS. This is me adding this in here. However, it's more likely that they're ditching it to try and disarm the naysayers.
Yeah, that's code. You got to decipher the PR code there.
Exactly. Because as I was saying, in the past, lawmakers and regulators have accused Robinhood of being reckless towards its newbie investors by making light of decisions that involve real money. And there's actually, this article brings up an interesting example, which I did a little bit of digging on. Last year, Massachusetts regulators filed a complaint against Robinhood, citing the company's aggressive tactics to attract inexperienced investors, its use of gamification strategies to manipulate customers, and its failure to prevent frequent outages and disruptions on its trading platform. So that was in December of 2020. And the quote here from, I believe, the regulator is Robinhood, which earns revenue for trades executed by its customers, gave customers with no investment experience the ability to make a potentially unlimited number of trades without properly screening them to be approved for options trading, a statement released in conjunction with the complaint reads. According to the regulator, 68% of Massachusetts-based Robinhood customers were approved for options trading after reporting limited or no investing experience. And this is the thing. This is where people are getting a little bit up in arms because here Robinhood, and you can understand why, their business is built around the small investor, and the message that they promote is that they stand up for the small investor. They say that they democratize investing. They want to enable anybody that signs up to do anything that they want to do with their money. They don't want to, you can't do this. Only the professionals can do that. You can't do that because, only Warren Buffett can do that. That they want to get rid of that mentality. But sometimes, and people, like we were saying before, raise this issue that maybe average people with no investing experience are not encouraged to do those sort of actions like options trading for a reason, because it does take quite a while to wrap your head around how it works. I mean, even me right now, I still am not fully up to speed with how options trading works. It is
likewise.
not my strong point at all.
Likewise, it's interesting to see this whole industry unfold because the way I viewed it, and maybe this is wrong, but the way I've seen it is it initially started with anyone can access investing by using something like a robo-investor. You have something like Acorns, I think, what's it called now? Raise, where you would just set aside a little bit of every expense that you paid, you would set a little bit to invest, and it would invest it in a basket of stocks. A hands-off kind of approach for a retail investor, but giving access to everyone and saying, hey, this is kind of cool. You can put a little bit of money away and it'll grow over time. And now it's kind of devolved, and then it kind of devolved into brokerage-free sites. You can pick any stocks you want. And then it moves to, well, now you can use leverage. Now you can take on margin. And now you can use options. And now you can short a stock. Like it kind of has moved into, yes, everyone, it's good that access is increased, but there's a consequence to that because
there is
a lot of people probably shouldn't be messing around with those things. I don't mess around with options. And I would say that I'm fairly competent with investing, I would like to think. And it really concerns me when I hear people jumping into the stock market like within a month and then jumping on options trading. It can be very dangerous.
Yeah, no, I'm in the same boat. Overall, and this is a question that I kind of thought about, and I'm interested to hear your perspective on it. Do you think that overall Robinhood is a net positive for the world? Actually offering these, the services that they do, the commission-free trading for small-time investors, or do you think now it's a net negative? Because we've seen things like the GameStop saga fueled by Robinhood, people literally gambling, extreme gamification of investing. Do you reckon it's a net positive or it's now a net negative?
Honestly, I'm not sure. I'm not sure because obviously they have reduced some barriers to entry, although I didn't personally think the barriers were that high. I mean, $10 a trade at a big bank that's been there for a very long time, a $10 investment and it being a slow, steady process to me is not a barrier in the sense that it prevents you from doing it, but it's kind of a reminder that you're doing something serious. But yeah, I don't know. I mean, certainly it's gotten a lot of people thinking about investing and getting excited about it. And to what value that has, I don't know if you can put a number on that. And on the exact same other side, you really can't put a number on the damage that it's done to people who have just transferred their idea of betting from sports bet to now messing around with options and maybe even getting involved with much more money that might not even be theirs. Because if you jump on sports bet, they're not going to give you margin. They're not going to give you debt to bet on horses, but Robinhood would. And there was even a mistake they made, which Reddit found out about, where you could get unlimited margin. And there was devastating consequences to that. There was one person who took his own life from that. So I don't know. I'm not against Robinhood as a business because I think people can make their own decisions. And as long as they're very sharp on only letting adults use the platform and not letting kids get around, use a loophole to get access to an account, then you're an adult. It's your money. Do your own research, be smart about it. But there is consequences to it in the same way that a gambling company that targets 18-year-olds, there's consequences to that, whether or not you think they're old enough to make those decisions, if that kind of makes sense.
I like the way you put it. And I agree with you definitely. It would be hard to actually say whether it's a net positive or a net negative. But you can definitely see there's arguments on both sides. So if you have tell us what you think. Head over to the video version of the podcast and just let us know. Drop us a comment. Do you reckon that Robinhood, the free brokerage app over in the States, is a net positive or a net negative? I'd be very interested to hear what people have to say. Yeah. All right, should we move on to this next news topic?
Yeah, what have we got?
All right, sure. Where should we go? I'm trying to see how long. Oh, we've still got plenty of time.
We got plenty of time.
Let's talk about Joe Biden. Hey,
ooh,
we love Joe.
What has Joey done this week?
He has unveiled. Well, I don't know if he might be unveiling it right now. I think this is like how they kind of know what he's going to announce before he announces it. But I think it's happening today. Right. He is announcing a $2 trillion infrastructure plan.
Whoa.
So guess what? We're going to see even more economic stimulus from the US government. So the plan here, US President Joe Biden unveiled more than $2 trillion infrastructure package on Wednesday as his administration shifts its focus to bolstering the post-pandemic economy. The plan Biden outlined Wednesday includes roughly $2 trillion in spending over 8 years and would raise the corporate tax rate to 28% to fund it.
Uh-oh.
Yeah, an administration official told reporters on Tuesday night, speaking on condition of anonymity in advance of the announcement. The White House said the tax hike, combined with measures designed to stop offshoring of profits, would fund the infrastructure plan within 15 years. That's still a long time. So this is a little bit more about the proposal. So that's how it's going to be funded. It's going to be funded by increasing the corporate tax rate. It's going to be funded by chucking in some extra rules to prevent offshoring of profits. The proposal itself would put $621 billion into transportation infrastructure such as bridges, roads, public transit, ports, airports, and electric vehicle development. So they aim to revamp 20,000 miles of roads and highways and repair 10,000 bridges.
Oh,
how insane is that?
That's
10,000. The proposal calls to build a national network of 500,000 electric vehicle chargers by 2030 and replace 50,000 diesel public transit vehicles. Beyond that, it also aims to get $400 billion to care for the elderly and disabled Americans, inject more than $300 billion into improving drinking water infrastructure, expanding broadband access and upgrading electricity grids, put more than $300 billion into building and retrofitting affordable housing, along with constructing and upgrading schools. So they hope to build or rehabilitate 500,000 homes for low and middle income Americans. And lastly, they want to invest $580 billion into American manufacturing, research and development, and job training efforts.
Whoa.
So big news, but I guess this... I mean, people are saying, oh, look at what Joe Biden's doing now. They're going to be printing even more money. Here comes inflation kind of thing. But I don't know. It seems like from what they've announced that they're not planning on taking a massive chunk load of debt or anything.
Yeah, I guess they take debt kind of up front in a way, and then over the back 7 years, it kind of gets paid down between...
Yeah, actually true. That's true, because they're saying it's going to be paid off within 15 years, so they must have to.
Yeah, so the $2 trillion is obviously spread out over the 8 years. It'll be like a little chunk every, whatever it is, $250 billion a year or whatever. But yeah, I guess they would need some debt in the short term, but the idea is that it's funded. Like they have a way to pay for it. They're not just spending out of control. But yeah, I mean, it is a lot of money. It does make you think. But I mean, my immediate thoughts on this, honestly, is there's a lot of people who, especially in the investment field here, will just immediately yell, "Oh, they shouldn't be spending money. Like this will cause inflation." And I think to some extent that is a concern, but like it's necessary for the government to spend money on certain things. I heard a really good example a while ago. And it was like the reason why they need they have a government run post office is there will be people who live out in, say, like on farmland or something, where there is no way that it is ever going to make profit sense for a UPS or a FedEx to deliver to people out there. So you either need a regulation that forces those businesses to deliver to those people, or you need a public service to deliver there that doesn't need a profit motive. And for some of these things that you mentioned, like drinking water infrastructure and electric grids, there may not be a profit motive, at least right now, for businesses to spend money in those areas. So it makes sense to spend money in those places. But yeah.
No, that's a good point. That's a good point that you raised, and it's something I didn't really think about. That, yeah, of course, there's going to be some things where, the government needs to step in, otherwise it just simply wouldn't happen.
Correct, yeah.
And I guess that's the ongoing argument is, well, how much does the government step in? And, how much of a player on the field does the government become?
Yeah.
And that's really, I think that's the real political argument, instead of, they shouldn't argue, whether the government should play a hand in this at all, or we should just leave it completely up to private, enterprise. The argument should be, okay, well, how much should the government do in these different areas, and how much should it be about, private business, private entities trying to, turn a profit and grow in that sense. But I think that's another discussion to have for another day.
Yeah, I think my main kind of like caveat to that, like in terms of what I said before about, of course, the government needs to spend is, I guess we don't really know how much spending is going to take place over, let's say, the next 4 years, maybe the next 8 years, with Democrats in power who are more likely to lean on the spending side. And we've already seen 1.8 trillion in stimulus. And I know we're just coming out of a pandemic, so of course it's necessary, but it's whether this sets a precedent where the Democrats continue to do these kinds of things frequently.
New normal.
Yeah. I mean, we get 1.8 trillion in stimulus, and we get 2 trillion in infrastructure. And then, 6 months later, we do another 2 trillion. And then 6 months later, we do another 2 trillion. And you do that for 8 years. Does that have an impact on inflation? Sure. That scares the crap out of me. But, we don't know. It's we have no idea what's going to happen. We just have to see how it plays out. Some of these things hopefully they spur some economic growth for jobs and that sort of thing, and therefore create more wealth and can maybe fight back against that inflation a little bit. So we will see.
And it's plans like this that I actually don't mind. Like I kind of, we're just going to, we're the government, we're just going to print ourselves, or the central bank is going to print ourselves some money, and, we're just going to spend it, full stop. And, that spending is, we're literally, we're not even going to spend it on, trying new jobs programs or something. We're literally going to print money and give it to you.
Yeah.
It's just like, those plans are just like, well, it's not really going to do. I mean, the most it's going to do is people are going to spend that money back in the economy, and that's how the economy is going to be stimulated. But I like these ones where, they've thought it out. It's a plan to actually increase, jobs, spend on infrastructure, but it's also funded. This is how we're going to cover the costs of what we're doing, so that we're not just, essentially screwing every American and driving them up the creek a little bit,
Yeah.
But I guess that's all the balancing act. But yeah, anyway, we'll leave that one there. Let's move on. How much time we got? Still got a little bit of time?
Yeah,
we can get through this last one. This is just interesting. It caught my eye. We don't have to spend very long on this one. Microsoft wins US Army contract.
What?
Yeah, I know. The latest military supplier, Microsoft. So when I saw this, I was like, I'll check it out, see what's going on, because I imagine it's just going to be like, Microsoft is, providing Office 365 to all Army, or, you know what I mean? Or it's just like Microsoft is supplying cloud space for the US Army.
Microsoft builds a nuke.
Yeah. Well, that's the funny thing, because it actually turns out that Microsoft are going to be making some military hardware.
Wait, really?
And that is a little. It's not as exciting as what you think.
Okay.
They're not building.
I mean,
nukes.
I'm not excited. Just to be clear, everyone, I'm not excited by the idea of them building nukes. That was a joke.
But yeah, it was interesting because that caught my attention that it wasn't software.
Yeah, interesting.
So it says the Pentagon has announced that Microsoft has won a contract to build more than 120,000 custom HoloLens augmented reality headsets for the US Army. The contract could be worth up to $21.88 billion over 10 years, a Microsoft spokesperson told CNBC on Wednesday. Microsoft shares, they moved higher on the announcement, up 1.7%. And this deal actually follows a $480 million contract Microsoft received to give the Army prototypes of the Integrated Visual Augmented System, or IVAS, in 2018. So this is kind of like, how do you say, almost like a contract extension, I guess. Kind of like the proof of concept was this IVAS system, and now they're actually going to move to, it says here, the new deal will involve providing production versions.
Got it.
So a little bit more about this kind of augmented reality headset that soldiers are going to use. The standard issue HoloLens, which costs $3,500, enables people to see holograms overlaid on their actual environments and interact using hand and voice gestures. An IVAS prototype that CNBC reporter tried out in 2019 displayed a map and a compass that had thermal imaging to reveal people in the dark. The system could also show the aim for your weapon, which is kind of interesting. That sounds really beneficial if it actually worked well, but I feel like you'd try one of these things. In all honesty, with all this virtual reality stuff, I feel like you'd put it on and try it, and it just wouldn't work very well. I feel like that's where we're at with virtual reality. You'd be like, oh yeah, the spokesperson would say, yeah, this system, you're going to put it on and you'll see the aim of your weapon, and then you'd actually try it and it would just be terrible.
Yeah, you're out on the battlefield and all of a sudden a big thing comes up on your screen in front of your eyes, like, you need to calibrate, spin around in a circle 3 times, move your weapon up, move your weapon down, move your weapon to the left.
Yeah.
What the hell's going on?
Please spin your weapon 180 degrees. Please fire 2 shots into the ground and 2 shots into the sky.
Oh God.
Your weapon could not be calibrated. Please try again. Please move to an open area and try again.
Oh my goodness.
Oh, so true, isn't it?
No, but it's fascinating that we're now seeing some real, I guess, important applications of some of these technologies, because I haven't used a VR thing for a while, but I had one a while back, and I was just overly impressed. Obviously, it was glitchy, not very good at the time, but it was just impressive to see, like, wow, okay, I can see where this is going. Like, you can see,
it gives you a little bit of a aha kind of wow moment.
Yeah, exactly. You can kind of see, all right, this is going to get pretty good. I can see it, like, give us 20, 30 years and this is going to be perfect, and it's just going to be unreal. And the applications, like in the military, are very interesting. So yeah, good on you, Microsoft.
But of course, a news story like this doesn't come without controversy. So it says a group of employees called on Microsoft to cancel the HoloLens contract. They said, "We did not sign up to develop weapons, and we demand a say in how our work is used," the employees wrote in an open letter regarding the HoloLens contract. Days later, Microsoft CEO Satya Nadella defended the Army augmented reality project, telling CNN that we made a principled decision that we're not going to withhold technology from institutions that have been elected in democracies to protect the freedoms we enjoy. So, I mean, I don't know. I don't particularly believe that this HoloLens thing is the weapon. I think it's more of an aid. In fact, it probably helps soldiers be safer. But I mean, it's still military hardware, so you can understand why some people are disappointed in this move from Microsoft. Any thoughts on that?
Yeah, I mean, I kind of get it, I guess, but I mean, a military is necessary. I mean, you might disagree with some things that they do, but you need a military for defense, and you would want them to have the best equipment for that defense. I can certainly empathize with arguments about certain types of military action that people may disagree with, but I don't know. I mean, if you're an employee, you kind of do have a say in how you work. You can work somewhere else if you want.
Yeah, I guess so. You can leave. I mean, that's true. I mean, it's just like, you can, as a consumer, you vote with your money. As an employee, choose where to work. So yeah, if this was like, if this was a more extreme example, like, HoloLens, Microsoft wins HoloLens contract to help guide nuclear missiles at cities,
exactly.
then I feel like more people would be packing their bags and saying, you know what, I don't want anything to do with this.
Wait, what?
Yeah.
what are they doing?
Yeah, I don't know.
Bill Gates has the button.
Bill Gates sitting in his lounge room with that big red button saying, oh, do I press it? Do I press it?
Biden, lower the tax rate. Or I'm going to make your what are they called? I can't find it. The HoloLens. I'm going to make your HoloLens not work.
Yeah. Dear, oh dear. Yeah, that's funny.
Oh no,
they really have the power over your nuclear arsenal.
Why are they connected to the internet? Why are they connected to Microsoft's server?
Yeah. The whole of the American military runs off of Microsoft.
Yeah, they just
software.
have power over them.
Yeah, Bill Gates flexing some muscle. Dear. Nah, is Bill Gates even, I don't even think he's an investor in he doesn't even hold stock anymore, does he?
Oh, really? Really? Does he not?
Would he? Well, I don't know. Or maybe he does personally. Actually, he probably does personally.
Yes.
But I know that the
fund doesn't.
His foundation doesn't.
The foundation does not hold any Microsoft.
No, you can imagine he'd probably get gifted stock on a regular basis, Bill. Yeah, personally, true. I can't imagine he would be receiving no stock. As a bit of an ongoing bonus for his time. But yeah, anyway, all right. I've been talking for way too long. Geez, we're almost out of time. Should we do maybe just like one Q&A question and then hit the road?
Yeah, I reckon let's do one. We flew through today's session with a couple of news stories that were really, really big.
There's a lot to talk about.
Yeah, so where should we go? Maybe...
Well, here's a funny one. It says here, is it possible to extend the podcast time to 90 minutes? Personally, I love your content, own channels as well, and could probably listen all day. So there you go. We could just keep going to 90 minutes.
I mean,
but no. I don't know. We've pondered doing this before, like long podcasts versus short podcasts. And I think 1 hour kind of hits the sweet spot, 45 minutes to an hour. I've done podcasts that go for 2 hours plus, and it just gets to a point where it kind of drags on. And plus, it kind of just forces you to be succinct and actually provide a lot of value. If you put yourself under a little bit of time pressure to hit like an hour is still plenty of time, but it does mean that the podcast continues to flow. So I don't know. What do you feel like about podcasts? I feel like we're roughly about the sweet spot.
Yeah, I mean, we could consider it. Honestly, if we were able to do this in person every week, then I think we would easily crush 90-minute weekly podcasts because it's just flows so much easier. It's a lot easier to do. But yeah, I mean, we can consider doing that. Maybe if anyone else has any feedback on that and wants to share their thoughts, whether they prefer the shorter one, or not short, but 60 minutes, or whether they want 90 minutes or 120 minutes or whatever you guys want, let us know. We'll take some feedback under consideration as always, but yeah, I'm fairly easy either way. I very much enjoy spending this Thursday morning just chatting about a couple of things that have happened in the news story. Absolutely. So yeah, absolutely.
All right, let's do one actual Q&A question. How about this one here? So let's see. Toughest part at the moment is selling stocks that seem overvalued and then seeing them continue to go way up. In my case, Tesla, Nvidia, and Applied Materials. how do you guys stay away from the sell button?
Yeah.
That's an interesting one because it's definitely the trend at the moment where, if you're selling something right now, then probably if you check back in a month, it'll probably have gone up.
Yeah, pretty much.
I know. What are your thoughts here?
Yeah, I think there's a couple of different ways to unpack this. I think, first of all, in terms of when I find a really great business, the only reason I'm looking to sell it, assuming it's still great, nothing fundamentally has changed, even if it gets overvalued, I'll probably still hold on to it unless I don't have cash around to invest and there is a far superior opportunity. And in that case, if you're selling something that's massively overvalued and buying something that's going to offer you a much better deal, then you shouldn't really care about what the other stock does in the future. And I think the other side of that is just further on that is you really can't think about the investments that you don't make, which if you sell a stock, you're basically... You no longer hold that investment. So you shouldn't really care what that does, particularly if you are confident that it's overvalued. Businesses can keep going up if they're overvalued and that will unravel over in the future. So if you're confident that it's overvalued, then over the long term, it won't have mattered that you sold a little bit earlier, but you're never going to time anything perfectly.
Exactly.
And most of the time, I just prefer to hold onto great businesses, let them run up. It was Peter Lynch that says you should water the flowers and cut the weeds, and not cut the flowers and water the weeds, which is what a lot of people do. They see a stock go up massively and they'll sell it and put it into something that's performing less well.
Yeah. No, I definitely agree with you. Generally, if I'm going into a position, I'm like, well, I want to hold this for, as long as I possibly can. So generally speaking but I mean, for example, this guy said, Tesla is a prime example, I haven't sold Tesla, but I mean, it's gone up into stupid kind of territory. So, there's that nagging sensation where you hover around the sell button saying, maybe I should, maybe I shouldn't. But yeah, I mean, I'm generally happy. I mean, if you can look out into the future, 10, 20 years, and you can see, you're still very confident that the company is going to be worth more than what the current stock price suggests, and you're still going to make good returns in the process, then I'm happy to keep holding. But if you get to a point where it gets so overvalued, where you look at the company and like, man, I could hold this for 20 years. And the company itself, looking at cash flows, could grow cash flows at like 20% annually. And in 20 years, then the stock price that we're currently seeing now would be fair. Then it's just like, well, okay, maybe I should sell this because there's not really much room to move. But generally speaking, I'm more in the camp, like you say, if you're holding something that you really like and you think it's going to do well in the future, just keep holding it. And that kind of keeps me away from the sell button a little bit.
Yeah, very tricky though. It's
super hard. Yeah,
it's all a part of that whole psychology and temperament is the most significant impactor of how you perform when investing, and you just have to have your set of principles, make it clearly defined, write it down, stick it on a wall if that's something that you need to do, and that's your principles. You don't let your emotions or the movements of the market affect that. If you've sold a stock because you think it's overvalued and it goes up, don't let your emotions drive you just to buy it back just for the sake of it, right? Have your principles and be very distinct on that, I think is a good way to go about staying away from the sell button if that's necessary.
Yeah. And at the end of the day, if a stock goes up a lot and you decide to sell it because it's overvalued and it continues to run up, that's not a failure, that's a success.
Yeah.
You've still made money. Okay. At the end of the day, investing's about making money, right? And if you do that, then you're winning. So, even if you buy it at 1 and it goes to 100 and you sell and then it goes to 1 million, you've still made money. So it's still a good investment. So try not to beat yourself up too much about it, I guess. Yeah.
All right. Should we?
All right, let's wrap things up.
Yeah. Do you want me to wrap up things
sure.
for today? Yeah. Thanks everyone for tuning in. And as always, if you have questions for next week, then head over to the YouTube version of the podcast at youtube.com/The Young Investors Podcast. Just click on the latest episode and you can leave your questions or topics or news topics that come out that week over there. And we always head over to the comments and see what's the feedback, what are the questions that people have, and what topics people want us to discuss. So head over there if you haven't already. But thanks everyone for tuning in. Thanks to Sharesight for sponsoring this week's episode again. If you want to get 4 months off a yearly subscription, head over to sharesight.com/young investors. Thank you, Sharesight. And thanks, Brandon, for tuning in with me this week again.
All good. Always good fun.
Awesome. And we'll be back next week. See you later, guys.
See ya.